Hi, my name is Keon. I'm a research analyst here with Lipper, and I'm here to talk to you about fund flow activity for the week ended Wednesday, September 2nd. Overall, for aggregate net flows, we saw outflows of $7 billion on the week. This was the second consecutive week of net outflows, as we saw $5.5 billion leave last week. All the macro groups except for equity funds experienced net outflows for the week. Money market funds led the way with $10.3 billion leaving their coffers, followed by Muni Bond funds, which saw approximately $585 million leave. Taxable Bond funds, just a slight decrease at $40 million. And the aforementioned equity funds took in about $3.9 billion on the week. It was a volatile week of trading last week in the market. We saw 4 triple-digit move days, 2 up and 2 down. Overall, the Dow Jones and the S&P 500 managed to eke out gains of 0.4% on the week. Some of the reasons behind last week's volatility included continued concerns out of China. Poor economic data out of China tanked the markets one day. But China did announce that they were taking steps to stabilize the trading in their markets. These 2 announcements, which included tightening of controls around index futures and derivatives, as well as implementing controls so the currency doesn't decrease too much against the dollar, both buoyed the U.S. markets on the days they were announced. Other positive factors for last week's market activity included the revised GDP numbers, second quarter GDP numbers out of the U.S. They revised sharply upwards from 2.3% to 3.7%. Once again, giving rise to the speculation that the chance for the Fed to increase rates during September was not dead yet, which many investors had thought, considering the unrest out of China over the last 4 weeks. Other positive news included a bounce in oil prices last week after approximate 2-month downturn, which saw both the WTI and the Brent crude hit 6-year lows. There was an appreciation last week, approximately over 20% for each index over several trading days. Let's turn our attention back to the fund flows activity now. Taking a closer look at our macro groups, breaking out by mutual fund, we see equity mutual funds saw about $865 million leave last week. Taxable bond funds had $4.4 billion in net outflows. Muni bond funds saw about $445 million leave, and money market funds, as we stated before, had $10.3 billion leave their coffers. Taking a closer look at equity funds now, the $865 million in net outflows was despite positive performance by the group over the week of about 0.4%. This marked the 5th week out of 6 that we saw net outflows for the group. Once again, the continuing trend that we've seen most of the year. We saw positive net flows into non-domestic equity funds of about $750 million and net outflows out of domestic equity funds, roughly $1.6 billion. Moving on to the ETF side of equities now. We see they took in about $4.8 billion in net new money last week. This comes on the heels of $15.2 billion in net outflows for the week before. The main player this week, as far as inflows are concerned, was the Spider S&P 500 ETF that took in about $7.2 billion. On the outflow side, we see the iShares MSCI Emerging Markets had about $520 million leave. Moving on to taxable bond funds now, starting with mutual funds. As we said before, $4.4 billion in net outflows this week. Again, this group also had positive performance on the week of about roughly 0.2%. This is the 6th consecutive week of net outflows for this group, during which time they've had about $15 billion in total leave. Investors seem to be running away from the more risky categories this week. We saw high yield funds had net outflows of roughly $715 million, and loan par funds had about $450 million leave. Overall, the year to date for these 2 groups, loan par has had $9.2 billion in net outflows, while high yield funds register at $3.9 billion in net outflows. Moving on to ETFs now for taxable bonds. They had a positive week this week, taking $4.3 billion in net new money. 3rd consecutive week of net inflows for the group, a total of about $7.5 million in net new money for this time period. In this week's activity, you see that Treasury products were taking in the bulk of the positive flows, led by the Spider Barclays 1 to 3 month T-bill ETF, took in about $850 million, and then followed by the iShares 1 to 3 year and the iShares 7 to 10 year Treasury, which took in $700 million and $570 million respectively. Let's move on to a new group now and look at, excuse me, our Muni Bond Fund category. Overall for the week, we saw roughly $550 million leave the group. Again, this group also had positive performance, so, just slightly, but, they were on the plus side at 0.2%. Also, this is the 5th out of 6 week net outflows for the group. Once again, the main player here is National Muni Funds that had $460 million in net outflows on the week. And the main category within that group contributing the most of the net outflows was high yield munis, which saw about $125 million leave their coffers. Let's move on to our last category now, money market funds. As we stated earlier, they were the largest outflow on the week with $10.3 billion. This reversed a trend. We had seen 4 consecutive weeks of net inflows for roughly $50 billion, so there was some significant money flowing in. The main contributor to this week's net outflows was the institutional U.S. Treasury money market funds, which had just over $12 billion leave. Well, that wraps up this week's report. If you'd like to take a closer look at the data for yourself, please join us at our website, www.lipperusfundflows.com. And please join us here again next week where another analyst will be talking to you about that week's fund flows activity.